Hello, everyone.
Hello.
Hello.
Hi, good morning, everyone. Vilas is joining in a minute.
Good morning, everyone. Welcome to day 2 of our program. Give us a few more minutes before we begin. We'll be beginning shortly. Thank you so much for joining, and we welcome you.
Hello, everyone. Just give us a minute so everyone is joining, and then we'll start from there. Mauricio, do you want to try your screen share? Just making sure that everything is working.
Sure. I just have a few slides. Hopefully it will be more of a conversation.
No, absolutely. We'd love to.
Can you see it?
Yes, perfect. All right, so let's probably get started so we can have people joining on throughout the program, but then we can go and talk about it a little bit more.
Perfect.
So, all right, awesome. So welcome everyone to the day 2. Our first speaker is Mauricio Comi. He's a head of small business insurers at Intuit. Mauricio has a passion for helping small businesses succeed. Since joining Intuit in 2017, Mauricio has led teams focused on developing partnerships in the payments, lending, and employee benefits industries in an effort to help small businesses get paid faster, save money, and grow. Since 2018, Mauricio has led Intuit's small business insurance business, where he now focuses on improving the way small businesses search, buy, and manage their insurance coverage. Mauricio hopes his work results in more small businesses having the insurance they need to protect them from the unforeseen incidents, as many are uninsured or underinsured today. Prior to Intuit, Mauricio led teams in Facebook, the Boston Consulting Group in Mexico, and Sony in the United Kingdom and Australia. He holds a business administration degree from Bocconi University in Italy and an MBA from Intuit in France and Singapore. So, Mauricio, all to you.
Perfect. Thank you, Blas, for the introduction. I was going to start with a little brief intro about myself, but I guess you already took care of that. It's really exciting for me to be chatting with you. I haven't been in Italy in a long time, so it's always good to see a few Italian names pop up on the screen, and maybe even do a little bit of this conversation in Italian. So if you guys want to ask a question in Italian, please feel free to do it, and I'll take the opportunity to practice. So yes, like Vlas said, I've been working in insurance for the last 2 years. But before that, my background was entirely different. It was in the financial services space, working in different roles in different companies. But since 2 years ago, when we discovered the opportunity for insurance for Intuit, I just completely fell in love with the problem, and that's what I've been working ever since. So what I'd like to do today is first give you a high-level overview of Intuit, who we are and what we do. It is not a company that is present in the Italian market. So hopefully with that introduction, you can get a little bit of color of what our core business is. from there, I'll jump into some trends that I'm seeing in the insurance industry that are very interesting. I know in the European market, maybe some of these trends are happening even faster than here in the US, where the regulatory environment is much more complex and complicated. And then towards the end, I'll give more of an overview of what Intuit is doing in particular with regards to insurance, where we see a massive opportunity. Does that sound good? All right, awesome. So let me pick up my screen slides again. All right, so Intuit is in the financial services space as a software provider that helps. It's primarily focused in consumers and small business to help them manage their financial lives. Our four main brands are the brands that you see here on the screen. QuickBooks is the largest accounting software for small businesses here in the US. Actually, let me make this bigger so you guys can see it better. QuickBooks it's an accounting software. Originally, it was desktop install. You had to buy a box with a CD in the supermarket or at the media store. Now it's cloud-based accounting. As part of that cloud-based accounting service, we have also built a number of capabilities that we call them attached services. So we are one of the largest payroll providers in the United States. Last year, we moved around $400 to $450 billion in payroll volume, and around 1 in 14 full-time employees in the US were paid with our software. We have a payments business, so similar to Stripe or some of the companies that do this, transactional capabilities digitally. We're helping small businesses get paid in more modern ways. We are particularly good in those places where small businesses don't have either a storefront where you use a point of sale, where maybe a company like Square would be your ideal partner, or online where you have an online shop and Stripe would be your processor. We primarily help people that use more like an invoicing, and we replace checks, which, believe it or not, in the US are still pretty widely used. About 4 years ago, we also started doing lending. And this one is important as we jump into the insurance story as well. On the lending side, we realized that because we have all of the accounting, we also have a connection directly to a customer's bank account, and that is how the data gets pulled to do your books. We were able to have very rich data on who the customer was and be able to create a risk profile on that customer that might even be more sophisticated than what a bank would normally see. So we have started lending out of our own balance sheet, and this is a business that is growing very rapidly. And the premise for how to do it and why it's going so well is that our cost of acquisition for a product like lending is close to zero versus what a normal traditional bank would have to pay to acquire that customer, or even a new let's call it lending tech startup. They're going to have to spend a lot of money on cost of acquisition. For us, that's zero. 2, we have data to do underwriting. So for the most part, many of those customers would be pre-approved even before they start applying with us. And then 3, by being tightly integrated with your product, you're managing your accounting, and the lending management becomes an integral part of your offering. So this is something that we started three years ago. It's going fairly well. The last year, obviously, it slowed down a little bit because of COVID. So not a lot of people are asking for new loans, but we expect that to go back again. And then for the last 2 years, I've been trying to drive this new business opportunity on the insurance side, where we operate under the same premise that we can acquire customers for free practically, that we have a lot of data that helps us target them from a marketing perspective, where we have a certain understanding on who the business is and what they might need. We can use that data for underwriting. And then last, in the future, where we hope that we can create products that leverage data that insurance companies have never seen before, because they just simply have never had access to it. That's our product focused on small businesses. We have three main products focused on consumers. I don't work in those areas, so I'll just give a high-level overview so that you get a bigger context of who Intuit is. TurboTax is our largest brand. Doing taxes in the US is incredibly complicated and painful. So this software allows people to file their taxes at the end of the year. It is a do-it-yourself. You can do it on your mobile phone. You can do it on your computer. And in the last couple of years, we've also enabled a accountant-assisted version of TurboTax for people that have questions or have slightly more complicated tax situations. This product is a large business. We have a very large market share in this space, and our competition here is either people that just do it manually themselves at home, which is fairly complicated, or work directly with accountants. We don't really have a competition in the software side. We also have a brand called Mint. This was part of an acquisition that was done about 12 years ago. This is a personal finance management product that, sorry, my phone is ringing. Personal finance management product that allows you to manage all of your bank accounts in one place. So we've built the capability to log into pretty much every single type of bank account in the US, whether it's checking, savings, brokerage accounts, 401ks, which is our pension funds type of accounts. And it aggregates everything in one place. And what it enables you to do is for you to track spending, track where you have different types of costs, and it allows you to create budgets to manage your expenses. And then last, Credit Karma is a super interesting new member of the Intuit family. We acquired them last year. Their focus has been to help people manage their credit scores. Not sure if you guys are familiar with how this works in the US, but essentially for you to get credit, everybody has a score that gets reported to these credit rating agencies. So Credit Karma has made it very easy for people to see their credit score, see how it's changing over time, use it as a way for you to help you manage your planning your investments in your life by helping you manage this score. So once you have visibility on that score, they also offer you financial products like a better type of credit card or a better type of loan so that you can improve your financial situation. And we acquired them last year for about $7 billion. So I wanted to start with the products because here at least it gives you some color on how we interact with our customers with our main offering.
So Mauricio, a quick question here. So in terms of integrating everything together and kind of through the acquisition and through building it out, so how do you actually build the systems that can actually talk to each other and can access the data both from the technology and the operational standpoint?
Yeah, it's a super good question, Blas. So the customer facing brand are not integrated, and that is by design. They are solving very different problems, and that is why we promote them as independent services. Now, on the back end, we do have common services that allow us to do things in a common way. So, for example, for QuickBooks, we have an integration to the bank accounts so that when you are doing your accounting, instead of it being a very cumbersome and slow general ledger data entry exercise, all of the data comes in automatically. And then all you have to worry about is at that level of work that is one hierarchy up in terms of trying to identify things that are more intelligent on how to manage in your books. That same service to integrate to the bank is the same service that Mint uses to pull information. So there are a bunch of common services that anyone else in the company can offer. So over time, it allows you to have, it's kind of like, you can build websites on top of Amazon Web Services. We can build products on top of core capabilities that that can be used by any one of these products. And another example is we are launching a credit card for small businesses on top of QuickBooks. So for that, we're becoming an issuing bank in a way, and that card has also a store of value. So in a way, it's like a quasi bank account. That service is going to be offered to Credit Karma as well if they wanted to offer a similar product. So there's a whole bunch of core technology on the back end from a data perspective, from a money movement capabilities, from a underwriting technology, from a risk assessment technologies. All of these can be leveraged by anyone else in the company to offer the solution that they want to do. With insurance, I hope to do the same. I'm starting focused on the small business space. That's where we see the biggest gap and the biggest opportunity. But there is no reason why, once we have built all of the capabilities, that it couldn't be offered to consumers on any of these 3 other platforms. We just have to identify the right products and the right way to go to market with those products. But at least all of the backend capabilities will be already there. Does that answer it, Blas?
Yeah, it does. And then the question becomes is that when you said that you keeping them separately, are you trying, because you're trying to address different customers? Are you trying to make that experience sort of more tailored, or is just like for the time being, because you went through this acquisition and you'd like to keep them sort of separated?
So an important part of it is that they have these services have come mainly as part of acquisitions. So Mint was part of an acquisition, Credit Karma was part of an acquisition. I believe TurboTax might have been an acquisition too. I'm not certain of that one. If it happened in the 90s, and they always stood strong as independent brands. So and Intuit as a brand might be less known in the market than the product brands themselves. So I'm not sure if the company has ever had a desire to make it a single like Intuit app that does everything. Sometimes, maybe the grand aspiration to integrate everything under one roof, it doesn't quite work out. So that's part of the reason why I think it stays separate. If you look at the TurboTax need, is a need that every single person has, is a moment in time. It's a once a year event, and mixing that with your daily expenses that Mint helps you solve with. I don't know. I think it's a big ask that not many people. I'm not sure. It might dilute our offering and our value proposition.
Yeah, it makes sense. That makes sense. Thanks so much.
On the QuickBooks side, we have done integrations where we bring things together. So our payments business was part of an acquisition that became QuickBooks Payments. We have a time tracking service. So for our payroll product, for when you have hourly employees and they need to check in and check out, for example, in fast food type situations, that was called T-Sheets, and we just rebranded it as QuickBooks Time. So we do, once the product is, fits more nicely with our main offerings, it does become part of it.
So and maybe a question in terms of sort of insurance and as we're talking about it. So a lot of those data points seems to be contributing to the overall kind of risk, right? So are you actually collecting this data? Can you actually, if needed, access this data to, let's say, compile the risk profile for your client using all those applications?
Absolutely. So we can definitely do that, and it's in a way, it's obviously the customer's data is their data, and that is something that is incredibly important to protect. It is one of our core value propositions, and as customers trust us with their taxes, with their books, with their payment processing, we have to be very careful about how we manage it. Under no circumstances we ever share it outside of our walls, unless there is explicit customer consent. But it's very different when you're using it internally. One, it can be used for analytics, just to try to understand how things work. But two, it can be used for offering additional services that the customer might want. So if the customer wants insurance, instead of asking him 60 different questions, if the answers to those questions are already in the books, then we can only ask the things that are missing. So for example, in the lending space, we have created our own credit score. We have found it to be 40% better predictor of lending risk than FICO, which is the score that is being used that Credit Karma shows here. So with that score is how we are underwriting those loans, and that score is created with our internal data.
And then maybe another question. I apologize, but it's kind of interesting, right? When we talk about those initiatives and the data gathering, the idea is that by having better data points, we can actually offer better rates, better view, better everything. But what about the other side? What if actually getting access to more data is actually decreases chances of success or increases the premiums? So how do you sort of keep that? How do you keep those players who do not want to disclose their information because they're afraid that it might hurt their premiums or anything like that?
Yeah, so it's a good question, and I think that in the insurance side is one that we need to tread carefully. I think with insurance, you always have trying to think of the right term. You want to make sure that the customers that are good are not subsidizing the customers that are not good, right? And if people if we find that they have a higher probability of being a risky customer, then they don't have to buy from us. We're not sharing that data with the insurance industry overall. We're just using it to price our own product. So once I go into the strategy of my product, I can give you more details on it. But the way that we are thinking of it is we want to help small businesses be insured for all of their needs. And to do that, because we are an accounting product, we are not vertically specialized. We serve all types of businesses. What that means is that lawyers use our product, as well as wholesalers, as well as restaurants, as well as construction companies. So if you look at the breadth of types of risks is very broad. If on top of that you look at the number of products that these companies need, I'm not sure how it works in Italy, but at least in the US, which is a highly litigious society, a small business might need to buy anywhere between 4 and 10 different insurance products just to be able to operate. We are not going to be able to offer all of those products directly ourselves. So what we have done is our strategy is to create the most important products that we think can help the biggest chunk of these customers with covering their insurance needs. But then wherever we can't serve them, we're going to rely on external partners to offer those insurance products so that we can offer it all in one place. So it's kind of like a first party plus third party strategy, and customers can buy from those products, and those people are not receiving data from us. They have to go through the normal underwriting process in that side. If those companies are willing to insure them, then great. If not, then there will always be customers that will find it hard to be insured, either because of the nature of the business that they do or because of the signals that they provide the market with where they are. On the lending space, we don't give loans to everyone. If your books are not, if the data that the books provide show that you're a risky person to receive a loan, then we decline you.
So and then there's also, like, since you have Credit Karma, right? That means that you're almost trying to proactively mitigate those risks as well, right? So just making sure that this person is more credible, more insurable. So do you give that kind of information to the other businesses? Because for those of you who you don't know, the Credit Karma, right, is just provide actually the ways to increase your credit scores, right? So do you provide something like this for the businesses?
Exactly. So the interesting thing here is where a traditional lender might see the relationship with you as a transactional relationship that happens as a one-time event. We are building a relationship with you for your entire life, ideally, if we prove that we are giving you value. So it's very important for us to help you find ways to get better. In the Credit Karma is probably the best example for it. We have some smaller examples on how to do this better within QuickBooks. And the question is, how do you integrate that well so that something that helps here benefits you also here? For example, one interesting piece of work that we're doing with QuickBooks is helping customers improve their cash flow. If we help customers increase their cash flow, it's more likely that they're going to be able to get a loan more easily. If you have better cash flow, it means that you manage your finances better. And we know that people that manage their finances better, on average, are less risky for liability products as a measure of responsibility. So there are positive loops that can be created. I don't think we have fully cracked it. I think it's a very challenging problem to connect those two in a way that actually delivers the value that customer want, but that's the entire premise.
Perfect. Thanks so much.
Hi, Mauricio. This is Salvatore. Sorry, I might missed a part because I had problems with the connection. Do you plan to partner with banks and third insurance to offer this lending and insurance products to the customer? Or you are just collecting it from the outside, like a broker, for example?
Yeah, no. So we have different models for different types of services. I will speak mostly about the QuickBooks side. I know on the Credit Karma, there has been things that have been tried out, but I understand it less well. So forgive me if I don't go into that part as much. On the QuickBooks side, for lending, we do first-party lending, where we lend out of our own balance sheet. So we act as the bank to offer the loan. But we also have a lending marketplace to lend to customers that we can't serve, either because they want a different type of product or because they are a type of risk that we are not capable of underwriting. So our loans right now are, 6 months to 1 year, short-term, non-collateralized capital investment loans up to $100,000. If you want a 2-year loan and it's bigger than 100,000, then we have other partners that we will work with to offer you that loan. That's on the lending side. On the insurance side, right now we are working with 3 different partners. One is a broker. Their name is AP Intego, and they're mostly focused on workers' compensation, which is an employee protection type insurance that exists in the US. And we have also 2 insurtech companies that are they're MGAs, if you're familiar with the term, but essentially they're like carriers, and they're called Next Insurance, which is one of the largest small business property and casualty startups in the moment. And the other one is called Coterie Insurance, which is a more newer startup. Their go-to-market is a little bit different, but we're offering their products. We are going to be launching an Intuit branded insurance product that we have done a partnership with a reinsurance company. That one will hopefully go to market in the summer. It's going to be a liability product, and it will complement our offering. So like I was saying before, the strategy is to have our own products for the most important insurance needs, and then complement that with third-party products. So it is a tight partnership. And it's with chosen partners. I believe on the Credit Karma side, because it's more of a lead generation type strategy, and where they make their money more on, let's call it, it's almost like a finder's fee or lead generation fees. I think they're more open and they partner with more companies. Perfect. Any other questions on the product side? I'm sure we're going to come back to this as we start going deeper into our product stuff. Okay, from a sense of scale, just so that you get a high-level view, our 2019 revenue, I haven't updated for the 2020, it was about $6.8 billion, and it's growing at a pretty steady rate. We have about 50 million people doing TurboTax. We have about 7 million QuickBooks users, about 37 million users that use both Mint and Turbo is another product that helps with finance management. There's about 600,000 tax pros and experts that help small businesses with what they do with using our products, and there's about 650 third-party integration apps that you can connect to our overall product. So from a sense of scale, it's pretty big. One of the things that has been really interesting as we have conversations with companies in the insurance space, for example, is that when you're talking about this type of scale with people that are using your products in an engaged way, they interact with you, if not every day, at least every week or every month, and you have such rich data for them, it creates very, very interesting opportunities. These are people that are going to be your customers as long as we continue to deliver value for them for a long time. And it enables us to create the type of relationship that is beneficial to offer complex financial products in an interesting way. And then from a global presence, unlike most companies in Silicon Valley that you might know that are truly global, whether it's Google, Facebook, Uber, if you go from San Francisco to San Jose, all the hot names of the moment, those companies are truly global. Given the nature of the products that we build, which are definitely more complex, they have to comply with local regulation on how you manage those products, as well as being tightly connected to specific services, like, for example, credit scores. That's a very unique American thing. I'm sure other markets have something similar, but it's not quite the same. We have mostly been an American-centric company, and most of our revenue still comes from the US. Our largest markets internationally are Canada, Australia, and the United Kingdom. And you can see, it's part of not just the language benefit in operating in those markets, but it's also an approach of doing financial services that is more similar with the Commonwealth regulations that have come out of after the British colonies, that has given some sort of consistency. And then other markets where we have invested pretty big is Brazil, France, and India. A lot of our data science is done in Israel. There's a lot of engineering talent over there, and as well as India, where we have a pretty large engineering teams. So that's at a high level Intuit. The topic that I'd like to jump into now is...
There is a question from Francesco. He's saying that, so will you have your own balance sheet for liabilities, license, and capital requirements in the US and across other countries as well?
So right now, it's a good question. All of the additional services that are highly regulated are only being offered in the US. QuickBooks exists internationally, but in those countries, we don't have a lending business yet, and we're not doing insurance yet. Part of that is the regulatory complexity that it means to enter those markets that we haven't really explored. But the other part of it is that our customer base in those countries is smaller, and cracking the US market is such a big opportunity on its own that we are prioritizing just the US for now.
Mauricio, thanks. Just a quick one to clarify what you were saying before on the insurance business model. My question was more for liability. You're going to have your own balance sheet reinsured by a reinsurer. And then for the other insurance products, you're leveraging the MGAs. Did I understand correctly? Or
so in the US, you can be an MGA without putting your balance sheet at risk.
Okay, great. Thanks.
And for obvious reasons, our market capitalization is that of a software provider. If you look at our multiple, you can check. I'm not exactly sure where the price is today, but I think we are more than $100 billion in market cap, with north of $7 billion in revenue. So that's a pretty big multiple. If we put our balance sheet at risk, I'm not sure the market would price us at the same level. Maybe it would, especially if you see the price of companies like Lemonade or Root Insurance, who just did their IPOs recently. But at our scale, I'm not sure we would be rewarded in the same way. On the lending side, we started lending from our own balance sheet, but as we got bigger, then we've gotten extra capacity from a large bank that helps us with if losses are too big, then they cover us for a significant chunk of additional lending risk. In the insurance side, we're starting with a partnership where we have zero risk at the beginning. One day, maybe we can create a captive or something else, but those will be optimization problems for the future.
Great, thank you.
All right. So I'm sorry for this very painful slide. I was using it to present to my leadership team to explain what I see as an evolution in the insurance industry, and I'm sure this is something that you guys already know. So I'll cover it at a high level, and maybe we can have more of a conversation of what it means. But the evolution that we have seen in the insurance industry, in the US in particular, is one where it started as very agent driven. Selling insurance is very hard, as you all know. It's a complicated product for customers to understand. Having an agent to represent you while buying insurance and help you select who's the right carrier and the right product is an important service that has been provided to consumers. And in the US, still about 80% of property and casualty insurance is sold through agents. For some products, though, particularly in the auto space, there's an opportunity that the carriers have taken to go direct to consumer. The agent channels are incredibly expensive, as you guys probably already know. So these companies realized that for more commoditized products, it was much better to use the money that was being spent on agent acquisition and use it on above the line marketing spend, and then building or leveraging the advantages of call centers to do sales, less in a human, upfront interaction and more over the phone, to be able to acquire those customers much more effectively. Here in the US, Geico, who is part of the Berkshire Hathaway group, their advertisement is all over the place. I think every single person can probably recall the slogan of a gecko that says, 15 minutes, 15% or more savings for car insurance. I think every single person knows that. And that's because they are on media all the time. There was a study that I saw that there was an estimate that about $50 billion of Google's market cap could be directly attributed to insurance marketing spend. The trend that is emerging, though, that it's pretty interesting and is being made possible by all of the advent of these new services, is the concept of embedded insurance. So if you look at agent or direct to consumer, it's an insurance specialist offering you a product. On the embedded insurance side, it's changing. Travel industry was probably the industry that pioneered it. So because the product that is being insured is on the control of the company that is offering it, and the point of need is when you're buying that service, then it makes perfect sense for you to buy travel insurance when you're buying an airplane ticket, or for you to buy a car rental insurance when you're renting a car. So that's pretty obvious. But what we are seeing is that this trend is starting to accelerate, and where there's a whole bunch of new entrants that are going to participate in insurance. And the reason for this, we see it as twofold. One is because there is probably a gap today in terms of the insurance products to serve particular needs, or two, because by having that relationship with the customer, it allows you to offer a holistic service that is better, which also allows you to better monetize or save some money. Two of the most interesting entrants in this space are Airbnb and Uber. If you think about it, the insurance industry did not have products for companies to rent out a bedroom to people that were just traveling in and out. Most products were either home insurance, renter's insurance if you were renting it as to somebody else, or hotel insurance. But this blend of insurance where it's your home, you sometimes use it, sometimes you're renting it out, it looks more like a hotel. The insurance industry did not know how to price that, and it was essentially a new risk. So Airbnb took the responsibility to self-insure when damages happen to consumers, to renters as they rented out their houses. And as that expense started to get bigger, they realized that they had to create an insurance product that they could sell to their consumers, to their renters, so that they could reduce the overall cost of covering for losses that might happen with those customers, as well as offering a better service and increase the confidence that if you're renting out, there's a product here that can help you out. Uber's case is very similar. We also see a company like Tesla who enters the market to offer a new way of transportation. Their cars are digitally connected. They have enormous amounts of data about the customer. And in Elon Musk ambition and maybe also a little bit of arrogance, and I mean that in a good way, he thought that the insurance that his customers paid was too high, given the data that the cars had about those customers and the way the car was essentially safer than others. For example, there's been a whole bunch of cases in the US where a car that is parked gets damaged by somebody that walks by, but the cameras capture exactly who that person was, and eventually it allows that person to be identified and paid for damages instead of the insurance company having to pay for those damages. So Tesla has entered the insurance space. I think they are only in California at this point, but they're probably going to be looking for ways to expand. So, this embedded insurance industry is starting to.
So that's kind of goes from technology into insurance. But do you have an examples of maybe something that you mentioned about Airbnb, some of those traditional players, maybe some of those who are brokers, maybe some of those agents, how can they sort of fit into this picture? How can they assist with this larger digitalization happening with Tesla or anyone else?
Yeah, so that's exactly where I was going to go to. So essentially, if you look at what happens, and maybe just to jump to a very painful slide here of how the traditional insurance tech stack used to look like, is this here line towards the left. Insurance is incredibly complicated. There are many jobs that need to happen in order for you to offer an insurance product, and you know these better than I do, right? There is underwriting, there is risk assessment, there is in the US filing the product with the regulator. You have to do it with the 50 states. That's incredibly complex. You have to do the claims management, you have to do billing, you have to do all of the capital part. All of these jobs are slowly becoming modularized. And what I mean by that is that there's new companies or some traditional companies that are being able to create components out of them so that other companies can connect to it. And essentially a company like Intuit can enter the space without doing, having to do the entire vertical integration of the tech stack. So on the one hand, it requires to have from what you present to the customer, a modern interface. So that customers can buy these products in a more simple and streamlined way. But behind the scenes, there's a whole bunch of jobs that are being provided that at least the trend that I see in the US is that of modularization of jobs so that you can launch your own products. To give you a sense of scale, for the product that we are launching, we have 12 third-party companies that we are partnering with in order to be able to offer it. The companies offer we have payment processing from a third-party company. We have a policy management software as a service provider where we build the underwriting engine as well as the policy management capabilities. We have a carrier partner. We have a reinsurance partner. We have a third-party claims administrator, and all of those companies have to be able to work together. So I think that if the question that you're trying to ask yourselves is, how can we enter the space where we can offer insurance in a new way? If you are standing on the carrier side, you have to look at who are the companies out there that might want to be in the insurance space. How can you have a product that works for them? And how can you have a servicing model that works for them based on their strategic needs and what they want? This company that I was speaking about, Coterie Insurance, they are very interesting because they are probably the closest thing that I've seen to Stripe for insurance. If you guys are familiar with Stripe, they are a payment processor, and they developers love it because it's very easy. You go to stripe.com, and in by looking at their developer software developer kit, in probably 2 days you can build a payment processing capability for an e-commerce website. In the past, that would have been a definitely many months, but sometimes even longer process to identify who is the right payment processor for you in order to start collecting payments. In the insurance side, could we aspire to create something like that? So these guys have a very broad offering in terms of appetite. So if you buy a liability, if you want to use them for liability, they can insure most small businesses, and the way to offer it is through APIs. So if I wanted to sell their product, all I have to do is connect to their APIs, and they can sell that product, and they are taking care of all of the complexity of this tech stack underneath. There's another company in the US called, I think it's called Boost, and what they do is that they design and create products for you. So if you, I don't know, let's say that you are Petco, and Petco is the largest, whoops, sorry, one moment, my screen share stopped. Petco, sorry, give me just one moment. Let me do this again. Here we go. Petco, they are the largest retailer for pet products in the country. So if they wanted to sell a Petco branded insurance, Petco can reach out to Boost to say, hey, can you create a pet insurance product for us? Maybe leveraging our own data, maybe not, but where we can sell through our own e-commerce channel or in store. And the question is how to offer it. And they will create the product for you and also offer it as a holistic service. So it really depends on who the company is that is offering the product and what they need. Tesla is going all in. They are becoming an MGA. The same for Airbnb and Uber, at least in these markets. So maybe those companies are more looking for modular components that they can plug in. But there's going to be a whole bunch of other companies out there that don't want to do the investment that is required to offer that insurance product where they have such a prominent role. Maybe they're just playing a lead generation role, and the insurance company can have a bigger role in stitching all of these products together. This graph, I think, also illustrates a little bit where we are.
So, Mauricio, a quick question here. So, in terms of all those integrations and working together, one part is just having sort of this business acumen that, if it's Petco, then go to Boost, create it. But then the other part is actually integrating those data points and integrating that businesses together from technology standpoint. So who do you see is in the center of all those integration? Is it someone like Zapier, that kind of third party, or is it someone who's taking sort of a lead on an overhaul of the technical debt and technical build out? So how do you see that part playing out?
Yeah, so if you are relying today on legacy systems, I think it's going to be very hard. Because the legacy systems, maybe I'm not as close to it, so I don't know where the limitations are, but it feels more like an SAP type situation where is this very complicated software with lots of business processes that are tightly integrated in what we would call spaghetti code, and componentizing it would be pretty difficult. There are new companies that are building a modern let's call it underwriting and policy management software that are more modular, that are more flexible to create the customer experience that you want, or the carrier is building that thing entirely themselves. To give you an example, we did an experiment with one carrier some time ago, and they had done a pretty good job modernizing their quoting capabilities. And I think that that's where most insurance companies start, right? Let's enable simple quotes to be done online. Answer questions, you get a price back. They had even gone one step further to enable the purchasing part, which in the US, believe it or not, getting a quote is easy, but actually paying for it online is really hard. There's very few companies still where you can buy a product directly online, that you have to get into the phone with somebody, or you have to be in person. What these companies didn't do, though, is what happens afterwards, or even with the billing itself. Like they only supported us to do yearly billing. When we wanted to change that to monthly billing, which we think is an important distinction or differentiator in the space, because insurance can be so expensive, they couldn't do it. And the reason why they couldn't do it is because their billing systems and their policy management systems were entirely separate. They're entirely different tech stacks. They don't talk to each other very well. And where they do, it's very rigid. And making changes there would have been a massive IT project for them. And for us, what we wanted is just simple monthly billing. So we have found some companies out there that are creating modern policy management capabilities, where it becomes easier to take a financial service product, build it from scratch, and then offer it to market in whichever way you want. There's a company here in the US called Sure Inc., SURE Inc., and they're really good at this. They have built an amazing backend capability so that you can build insurance products on top of. But essentially, they become this unified engine that manages underwriting. It has the customer agent tools. It has notifications where you can send the notifications via email or text message, or even printed notifications. It allows you to track changes so that when the regulator inspects, you can see all of those things. And it's all done on top of a modern tech stack on Amazon Web Services. So I think that that's where part of the opportunity is. I'm not sure, in your case, how modern your tech stack is. If you have been in business for a while, I'm going to assume that a lot of it was built a long time ago, and that is going to be a challenge. So we have seen this company, Sure, they do work with insurance carriers. And when those insurance carriers want to innovate and offer new products to market, and they are seeing that it's going to take 2 years to build them on their legacy systems, they are partnering with this company to offer it outside of their normal business processes, and they're being able to deliver something that is much better. But in that case, that insurance company, then their job is becoming a little bit smaller in this value chain, where now they are just the insurance product itself, but the technology part, they are outsourcing it to a third party.
Perfect. Thanks so much.
And here, I think this graph illustrates it in an interesting way. It's always hard to quantify how many services are being offered from a different technological point of view. But where I see the insurance industry now is similar to where the banking and payments industry was about 10 years ago. 10 years ago, Stripe was being founded. 10 years ago, Square was being founded. A lot of the banking as a service capabilities that today are possible for any company like Google or Apple to offer a credit card were just in their infancy. And now, I think there's still a long way to go, but they're pretty common. They're pretty widespread. In the insurance space, I think it's just starting. A lot of insurance companies, like I said before, are starting to build APIs for quoting, and there's a lot of companies that are starting to use these APIs to make it much easier for you to find and compare prices between products. But I think that is going to continue to evolve so that you can offer this thing that I'm calling of a much more vertically integrated solution that is going to enable players like us to be much more effective. And the work that I've been doing at Intuit to partner with those 12 companies, it's very complicated. I think that if I was entering this space now, or maybe 2 years from now, we could go to market much quicker as more companies are building more capabilities. So here we see an interesting trend.
Mauricio, I just want to add here, because I was actually part of the team who launched the Apple Card with Goldman Sachs, and the interesting thing is that as you said, with everything as a service, with all this technologies being built, is that the focus really switches to the customers. What customers do we have and what we can offer to them? Because from technology standpoint and the execution standpoint, it's actually fairly easy to do those things, right? You can either find partners such as Goldman, or you can find even as a service solutions, right? So you really start not what technology we can build, but what our customers, who our customers are, and what do they need, and then we can actually go and create it.
And if I was to ask you how easy would it be to do that 15, 20 years ago, you would say that it was probably harder.
Yeah, it would be fairly, like, for the institutions such as Goldman Sachs, it would not actually like worth the effort, just because building the infrastructure without AWS, building the infrastructure without some of the modern technologies and already things that are built would be effectively impossible.
Exactly. So yeah, and you know, taking it back to insurance, I think the you know, these two charts are pretty telling. You know, the direct to consumer and agent channels, they're still going to be very relevant for the next 10 years. But if you see this dark blue trend here, it's the only one that is growing really rapidly, and that is the one of embedded insurance. China is ahead, like in many ways they are. With this type of services. I know the WeChat group has launched a very large venture focused on selling insurance product, and they're starting obviously from a smaller base where maybe less people were insured in the past. So they are being able to offer these products at scale. You know, between Europe and the US, there's some slight differences between whether your brokers and agents are independent or whether they are attached to a particular brand. So I think this is you know, difference between yellow and blue here. I'm not sure what the trend looks in Europe for embedded insurance or what the projections are, but I wouldn't be surprised if it looks similar to this. So I think that that's where I see the bigger opportunity. Now, going to what we are trying to do, and I think we've done you know, a little bit in circles on this topic. You know, for Intuit, it's an amazing opportunity. We see the property and casualty industry for small commercial. It's about, you know, for companies that are less than $10 million in revenue. I think the gross written premium is about $105 billion. And we think Intuit customers, so today's customers, the ones that are already using QuickBooks, we think that those are spending about 20 billion of that 105 billion. And we think that we have better data about them than what the insurance companies have. So I think the opportunity is, can we offer, for the best risks at least, a product that is better for them, whether it's through pricing or because we are modernizing the way that is being served to them. The concept of a yearly insurance premium, it's a weird one. It's fairly artificial. You know, why does it have to be a year and not a day or 6 months or whatever? Here in the US, there's also minimum premiums, where insurance companies have said that, you know, you create your formula to determine the price, and your formula, you know, the curve looks like this, but they put an artificial floor to it for the lowest risk. So the people that are, from a risk formula perspective, the people that are below that curve, they're essentially overpaying for insurance. And part of the reason for that is because the cost of acquisition is so high and the cost of serving those policies is so high. But if technology is making it so much easier to sell those products, and if the cost of acquisition is close to zero because you already acquired that customer, so you already spent the money for the other service, then it allows you to go down that curve much more easily and be much more competitive. And then the last part is, it allows you to have a relationship that is much more contextual, so that you are buying insurance at the point of need. So similar to, you know, when you get a mortgage, el mutuo, here in the US, to get the mutuo, you need to insure the property. So it's a perfect moment in time for those two services to be offered together. You know, can products like ours know enough about you so that we can give you the right insurance product at the right time? If we start seeing that you want to do, you know, if we see that you do mileage tracking in your QuickBooks because you are using the miles counter to decide how much of the fuel spend you are using to lower your tax bill, can we offer you insurance attached to that service? If we know that you're going to add your first employee to do payroll, can we offer you insurance for that service? If on the transactional data, we see that you pay your monthly antivirus subscription every month on time, you're probably a better risk for cyber insurance than somebody that doesn't have an antivirus. So this is the type of things that we are seeing on how we create that relationship, leverage the data to understand you better, and then use our product so that we can offer those services in a much more contextual way, so that it's not blasting advertisement in a very aggressive way where nobody likes to buy insurance, so it's annoying to see it. But when you need it and it's presented in front of you, and hopefully it's really easy, then that's great. And I think the future is where that insurance process is one of an easy opt-out versus a complicated opt-in. If you already have all the data, then you can just decide if you want it or not. Imagine if at the end of a QuickBooks purchase flow, you had a page that says, hey, now QuickBooks comes with insurance. If you want it, it's going to cost you X much more, and these are your coverages. Just click accept. If you don't want it, just say, I don't want it, and you're done. And it takes seconds. Today, we estimate that small businesses spend between 3 and 4 weeks researching an insurance product. It takes them a couple of days to actually buy it, as they start gathering all the information that they need. With modern approaches, we have seen, in the lead generation model that we're doing today, we have seen customers buy insurance in less than 5 minutes from the moment that they need it, the first interaction, to the moment that it's purchased. And I think we can take it down to under 1 minute if this is this easy opt-out. But to do that, you need to have rich data, and you need to have a strong relationship with that customer where you're offering a different service. So I think in the future, there's going to be some companies that are going to be capable of doing that because of the type of relationship that they have with their customer. Today, I actually saw an announcement that I think is it Alliance or Munich, who is partnering with let me just escape here one moment. With Alliance. So Google is partnering with Alliance and Munich Re to offer cyber insurance for their customers of their cloud service. That's pretty interesting, right? I think that's a perfect example of embedded insurance. They're trying to improve the service for their customers. They're realizing that cyber risk is a hot risk in the moment that people in the past have not been able to understand. And if you're trying to convince people that storing stuff in the cloud is okay, then probably attaching a cyber insurance product makes a lot of sense. So, this announcement is hot off the press this morning.
Awesome. So while our people are getting ready to ask questions, maybe I can ask you. So what do you think is you mentioned several topics, but what do you think is the biggest disturbance that is going to happen in the short term and the long term when we're talking about the insurance, be it business or personal insurance?
Yeah, I don't know if I'm going to be a good predictor, but here's something interesting. If you look in the US, the companies that are being more successful in the insurance space are the ones that are going direct to consumer. So Lemonade, Next Insurance, Hippo, Root, they are the ones that have done better compared to the ones that have tried to modernize the brokerage space. Because trying to modernize the brokerage space, I think it's incredibly complicated. The brands that I see, and by the way, these have been successful companies, just not in the same order of magnitude, are companies like CoverWallet or CoverHound, they have had exits, but their exits have been being acquired by a larger broker. So CoverWallet was acquired by Aon. I think CoverHound, were they acquired by Wallis? I think they were acquired by Wallis. And the numbers that we're talking about is in the hundreds of millions of dollars. Instead, Lemonade and Root, they've had a multi-billion IPO exit, and behind them you have companies like Hippo and Next Insurance that are valued at the $2 to $3 to $4 billion. So I think that's a very interesting and telling trend, where I think the reason why the brokers have not been able to succeed is because they are built on an old tech stack. The old tech stack is the same old products that are serviced the same way, and they are trying to build technology that hides all of the complexity that is behind the scenes. But to do that, they require a ton of people, and for the customer, the experience is actually not better. We did an analysis of what it takes to buy a BOP, a business owner policy, and how many questions were asked between Next Insurance and Coterie and Hiscox, for that matter, versus the ones in the modern brokerage space. And the difference was 2.5x more questions in the broker space. So for the consumer, that's incredibly painful. So I think that trend is going to continue. And I think companies like the ones that we've just named, they're going to be the future, Square or Stripe, that are going to be worth, if not tens of billions of dollars in terms of market capitalization, they're going to be worth, maybe even more, maybe even in the hundreds of billions of dollars. So I would say that that's the number one. The number two is that you're going to have a whole bunch of new players entering the space like we are, and where insurance is going to evolve pretty dramatically in the way that it's being bought and sold, where, imagine if products just come with insurance built in. If your car comes with insurance, instead of you having to go research it and buy it. What if the company that is selling you the car, the insurance is attached, the car is integrated with data with your carrier. If you are a crazy driver going on the autostrada A4 at 1,000 kilometers per hour, the car company will know, so your price will go up. But if you are a very safe driver, it doesn't matter what your age is, your price will be better. I think that is where there's going to be an interesting trend, and where for the incumbent players in the space, the question is going to be, are you going to be able to modernize to that world? I think it's going to require a rethinking of how you calculate insurance risk. Is going to require a rethinking on what data is used to measure that risk. But I think if today the curve for risk for consumers is there's a lot of subsidization, I think over time there's going to be less subsidization. The people that should pay less insurance are going to pay less. The people that should pay more are going to pay more, just because there's going to be more data available to be able to do it. And part of that is going to be because companies like us, who have thousands of data attributes that can be predictive of risk, are going to be entering the space. Let me give you one example. On the lending business, we have seen people that log into QuickBooks more frequently are less risky than people that don't log into QuickBooks frequently. That's interesting. Before, a bank can never see that. So I think that can be extrapolated to other things. Okay, I see a couple of questions in the chat, so let me see if I can here. So Francesco, you're saying the first company, please. This was a while ago. So Boost. So I mentioned Boost before. They are a company that does the backend service. I think the car company that I was saying is it Root Insurance? Let me just pull it up.
Yeah, I think you're right.
Root. I think it's Root.
Yeah.
Maybe Equator. I don't know what that is. Can somebody say what the question? What is Equator?
Mauricio, you were referring to a company called Equator Re before, but maybe we did not understand.
Maybe my English as a second language didn't come out right, because I don't think I know Equator Re.
No worries.
Okay. Is there any requirement to present various insurance options as the POS, which could limit
at the point of sale? At the point of sale.
Yeah. And by requirements, what do you mean? Like regulatory requirements, or?
Correct.
I'm not sure. I mean, when you're selling insurance in the US, the regulator wants to make sure that you're not messing up with the customer. And I think the things that they will make sure that are there is that the customer is aware that they are buying insurance, and that the price that is being charged is fair. I think those are the two most important things. For the price being fair, Here you have to file your calculation formula with the regulator in every single state. So you have to do that process 50 times so that they can compare it with other risks that might be similar and see how you're pricing it. So if you're modernizing the pricing formula, it's going to take some time to build that credibility with the states. The second part is that, obviously it can't be buried. If it's hidden and the customer is signing up for insurance without knowing, that's going to be a problem. But if you're upfront and you say, hey, this product comes with insurance, here it is, here are your coverages, then I think you can get away with it. It might not be as simple as, how people read the internet. Nobody reads anything and just click buy. Maybe it's going to take a little bit more steps, but it's going to be much easier than what it is in the past. And I'm not sure how it's in Italy, but when we bought home insurance for this house, it was terrible. It was a very, very painful process. The other day I got a quote from Hippo Insurance and I was blown away. Like literally with my address, they were able to give me a price because they connect data from like 30 different data sources to establish, they can see the type of roof that I have in my house because of the Google Earth picture. They can see how what color it is, which allows them to predict the material. They can see it over time, so they can see when was the last time that it was probably changed. They can also see where the nearest fire hydrant is, so they know that if there's a fire, whether the fire truck can come and spray water on it or not. And all of that information before would have been asked to the consumer. So I think that those are some of the things that made it painful before.
Thank you.
So as an insurance broker, what should do if the innovation can come just from the insurance company product? So are you guys an insurance broker? When I signed up for this, I heard it was an insurance company. I wasn't sure if you guys were, what role did you play? Are you guys an insurance broker? And I think this was from Gianluca.
Yes, correct. We are an insurance broker.
Yeah, so I think some of the interesting things that some of the insurance brokers have done here in the US, Aon, Marsh, those guys are being very successful. They are helping companies like ours create the program. You are uniquely positioned in the space to understand the entire space. So a lot of what they are doing today is, they help with the operationalization of insurance program, as well as with the consulting part. So, when we were looking at doing our own insurance product, one of the options that we had was to partner with one of them, and they would be the ones that would find the capital for us. They would be the ones that will help us with a lot of the process to, get licensed people to operate our business in our behalf. We didn't think in our case that was the best route, but I know that this is how many other players have done it, where you play more of a consulting view. I think an interesting question becomes, as a broker, if technology is part of your play, and if you're going to be playing the technology role, where do you want to be? I think that if you play the role that some of the companies have played here, I think it's less interesting. But maybe there's an opportunity for you to acquire a company like them and modernize your operations, right? If you go to that previous slide where I was showing the trends in the market, agency and broker sales, I don't think are going away. I just think they're not going to be growing as fast as the embedded insurance space. So I think the question would be for you, if there are companies out there in the Italian market, if that's your focus, that want to sell insurance, can you provide them with something that the other guys can't in order to put a product together? At the end of the day, it's pretty complicated. If I was focused only on restaurants, I would have taken an approach that is very different than the approach that I took. So I think the good thing in the insurance space is that there is space for many different types of players to play a role. I just think that the upside opportunity is bigger for those that are direct, or at least that's what the market has told me here in the US.
Mauricio,
yep.
One last question. You just said before that it's easy for underwriters in the States to create a quoting platform, but more complicated for the client to pay online.
Yes.
Can you, is there some data backing that, or just your advice? Because it's a bit weird from us in Italy that we see.
I don't think I've seen any research on it, but it's basically when we were looking for a moment for, when we started looking at this space, one of the things that I wanted to do was to be a digital broker. And it was very hard to do agency billing, leveraging carriers' APIs to manage this. So,
Clear.
and if you go and do a sample research, go to Nationwide, go to Farmers, go to a couple of their products. If you try it out, for many of them, you have to get on the phone to actually purchase the product. And this is changing because they are realizing that they need to, but it's been very surprising how slow it's changing.
This is something we have in Italy as well. There's a massive limitation in API from insurance companies to brokers or to distributors that allow also the admin side. So yes. Have you seen an acceleration in that, or?
Very slow, very slow. The companies that are being able to do it are the ones that are starting from scratch.
With no legacy.
So in the US, I have seen it, for example, Farmers Insurance, they launched a really good renters insurance product. If you go look online for Toggle Insurance, I can write it here. Toggle Insurance. Oops, sorry, this became a direct message to Gianluca. Let me send it to everyone. Toggle Insurance is a product from Farmers. They had to build it outside of their normal tech stack to be able to do this. But this one is a beautiful product. It's very nice how you can change the coverages. It automatically recalculates the price. You can buy a renter's insurance product in minutes, and it's an interesting innovation from a traditional player that they're probably seeing the threat of a company like Lemonade entering the space and being much more effective at acquiring customers than them in a direct channel.
Very nice. Thank you very much.
So Mauricio, maybe the last question when it comes to the unless we have some other additional questions before we go on the break. So traditional insurance have been very involved in the capital markets, right? Buying bonds, providing liquidity, doing all of this, and that usually requires a lot of sophistication when it comes down to just going in the market, CDS swaps, etc. So how do you think that smaller companies can play this game without access to those large capital markets present institutions?
I don't think they can. I mean, and by small, who you think is small? Like you think like the Lemonades and the Hippos?
It's maybe those, right? Or maybe someone who's trying to redefine themselves. Let's say that they're insurance company or they're the brokers that is trying to build something else, right? And obviously that a lot of those things that we have discussed about, everything as a service and all this is very scrappy, right? You can do it very easily, very little, collect the data, process this data. And then even build those models is relatively cheap, but getting the access to the capital markets to fund it is actually the complete opposite of cheap. So how do you actually can balance this?
Yeah, I'm not sure what the right answer is there. I'm sure you guys have a better perspective than me. I'm not sure it matters that much, and the reason why I don't think it matters that much is because I think. The companies that are very effective at doing this job in the capital markets, they are looking for ways to deploy that capital. And if the growth is coming from companies like, these smaller ones that are modern, that are scaling very quickly, then I think there's going to be competition to partner with them to have access to that market as a partnership. So I think, if you look at the case of Next Insurance, for example, they built this entire new business on top of Munich Re, and Munich Re has been their capital provider. So I think like Munich Re, there's many other players that are willing to play that role. I know in Italy, Generali probably is going to be doing some of these things where they can be the capital provider so that technology can scale. And I think there's an interesting analogy with the vehicle market. I think, what's the name of Fiat CEO? Is it Marchioni? anyway, the famous Italian CEO that leads Fiat as well as Chrysler here in the US, who, if you look at the market cap of Tesla, which is bigger than the top 8 car companies, and they sell, I think, 100th of the number of cars. Marchione. They sell many less cars than what the traditional players have. The quote that I think he said recently is that Tesla is creating value instead of selling many cars. You can say the same for Lemonade or for these guys who, if you look at the size of their IPO relative to their revenue, is disproportionate. Like it's the multiple is insanely large. And the reason why that I think that is happening is because they have figured out a way how to do customer acquisition that apparently is going to scale and is going to, as the flywheel starts going, they are going to be able to create the next insurance product and the next insurance product. So if you were to ask me how many insurance companies out there are going to be 10 times bigger than they are today over the next 5 years, it's not going to be the old ones. It's going to be the new ones. So I think that that enables these companies to access the capital markets to be able to do this. In a way, capital is cheap, honestly.
Perfect. Thanks so much. And then there is one more question.
So your experience, how banks are leveraging data analytics to develop better personalized products and pricing. I'm not sure. I don't know. I'm not sure I have seen this. Are you so Accordi? Do you have any examples that you think that make you ask this question, or?
No, nothing special. I was interested if you have any experience in this sector, in this specific field, because we are studying, we are trying to develop this kind of future solution with our partners. We have some programs about that, but we are in an early stage. A lot of words about that, but nothing special in concrete.
I think maybe the one distinction between banks and are you a banker as well, or are you just on the insurance space?
Insurance and partner with banks.
Okay.
So bank insurance sector.
Because I think bank products are much more commoditized than insurance products. So I don't think banks, at least the financial service itself, it doesn't lend itself to much personalization other than just changing like the terms of the contract, where price might be different or the duration of the contract might be different. I think where banks differentiate themselves is on the service side. In the insurance space, I think there's more opportunities to design personalized insurance products that are better suited for the needs of that particular type of customer. Because the insurance needs are much more broad, and the type of coverages, I think they can be more adapted to the needs of the company. So I think even though you can still commoditize a financial service like an insurance product to a certain extent, I think there's more room for flexibility. But that's as far as my banking experience go. So I'm not a banker.
Okay, thank you.
All right, awesome. All right, Mauricio, I think that this all the questions that we had. So thank you so much for joining us today and sharing what Intuit and you have been doing recently. So thank you so much for joining us today and talking to us. So have a wonderful rest of your day. And again, thank you so much.
Thank you so much, everyone. Grazie a tutti. Se volete contattarmi, mi trovate su LinkedIn. Qualsiasi domanda, sono felice di fare un'altra chiamata se volete.
E allora sarà fatto, grazie. Ciao. Ciao.
Grazie Mauricio.
Grazie.